Ladies and gentlemen, today we need to talk about a few AI stocks that I think are being criminally undervalued and mispriced in today's market. There is currently a little reset happening with the AI stocks, and the AI stocks have become a very broad range of names. There's the neo clouds, there's the photonics, there's the chip builders themselves, there's the hyperscalers, there's a lot of names to go over. But specifically, I'm going to focus on the photonics and the neo clouds because I think these two are being the most egregiously mispriced, as well as names like Nvidia and Broadcom. Let's jump into a few stocks and let's look at some charts as well. Here we have companies like Oracle, AAOI, Coherent, IREN, STMicroelectronics, CoreWeave. You can see it all here. Now, the way I have this set up is I have the current price, and then I have my 2-year out estimate. Now, some of these are earnings in the green. Some of these are operating cash flow in the orange. And this one should be green. Boom. And then I have a target multiple for each of these, and that gives me a 2-year out price target here, and here I have the percent upside from today's price, and this over here you can ignore. That would be for 40% upside what the stock would need to be at. Let's look at a couple of these names. For example, we have Coherent here at $325, and 2-year out estimate is $12 per share in earnings. They trade at a 40 times multiple. That puts them at a $480 stock. That's 48% upside. Not the highest of all of them, but still impressive. When you're looking at the forecast here, we have 48% growth in earnings next year, and then the year after that, 47% growth. And the stock is trading at 58 times today's earnings. Going out 1 year at 47 times earnings, they would be $389. That is already higher than they are right now. But imagine if they traded at a 57 times multiple, it would be a $467 stock in just 1 year. Just like that, you can see how some of these names have massive upside. Now we can look at like AAOI, 190% upside. Why do I think that is? Let's look at this chart here. Look at this growth. We're talking about 500% growth for this year, 313% growth next year, 155% growth the year after that. Now, there's only 2 analysts that are giving you that estimate, but still, free cash flow. The free cash flow is negative, but it's going in the right direction. 2 years from now, this company should be printing free cash flow. Operating cash flow, absolutely disgusting, explosive. Look at this, 20% and then 600%. That's one analyst, though, so we're not going to give that much credit. But let's look at over here, let's look at the revenue forecast. These companies are growing so fast, and that's why you're seeing a lot of volatility with these companies, because there's so much growth, there's so much change happening so fast that the market has trouble pricing them, and you get these momentary blips where you're able to pick up these great companies at not insane prices, because this company was trading at $220 at one point, is now at $119. It's corrected 50%. It's literally cut in half. And when you look here, this looks like the support zone around the $100 level, and you're at 120 right now, so not too bad. Overnight trading, you're at 115. Picking it up anywhere around here, I think in the long run, in the next 2-3 years, is going to be, you're going to be looking at a $300-$400 stock, no problem. Again, let's look at the revenue. Revenue growth is 100% this year, and then 150% next year. They're going to be doing $2.5 billion, and EPS is supposed to shoot up to $4.77, and you're trading at $119. Let's go to the statistics. You have a $9.6 billion company that's going to be doing $2.5 billion next year. What are we talking about? We're talking about 4 times revenue with operating income, net income positive, free cash flow positive. We'll see what actually pans out with this business, but you just have insane amounts of growth. What does AAOI do? They're in the photonics business. So it's all about the chips talking to one another, and that is slowly moving away from copper and going to move towards light itself through the fiber cables, the fiber optic cables. So it's literally going to be moving with light. I don't exactly understand it, but I understand enough that it's going to happen. It's happening. The people that understand more than I do are saying that this is still 2-3 years out from happening, but the physics is there, the math is there. It's going to happen. What's another name similar to AAOI in this space is LITE. Lumentum. I love this name. LITE is trading around $800. 2 years out, earnings are $30 per share. If they trade at 45 times earnings, that puts them at a $13.63 stock price. That's 69% upside. If we look at the chart, let's see. LITE. We had this dip all the way down to 700, which was catching the support here. Maybe we have to revisit that. The question is going to be, can we blast through the resistance around this 820 range up to this 860 range? That's the next zone that's in question. Long term, buying this company, this is a great price in my personal opinion, not financial advice. Now, 45 times earnings, that sounds crazy, right? But when you look at this, now does it look crazy? Look, this black line is the stock. We're trading at 94 times earnings today, but we're growing earnings 122%. That's from 24 analysts. That's the average. Next year, 58, almost 59%, and then 52% from one analyst here. When you zoom out and you look at what these companies are actually doing, let's look at free cash flow. Look at this. 400%, 79%, 52%. These companies are going to be printing money. There's massive demand. The AI race is not over. It's not a bubble. We're just getting started. The party's just getting started, especially for the photonics names, especially for the photonics. Let's look at the revenue growth. 81%, 86%, 50%. In 2 years, this company's going to do $8 billion in revenue. 56% earnings growth, 8 billion, and your 62 billion market cap. So you're less than 10 times 2 years out revenue. And let's look at some margins here. Operating margins are 10% right now. Gross margins are 40%. Not crazy, but you're already cash flow positive. You're already, I think, free cash flow. Yep, free cash flow is already in the green. This company's already moving in the right direction. If there's any name that's going to move crazy out of all of these, it's going to be the names that are already free cash flow positive, because the market really does not like companies that do not have positive free cash flow. For example, Oracle is one that's on this list that we can look at. And this is a company that's been punished heavily. When we look at Oracle on my list here, they're $140, going to do $15.76 in earnings in 2 years. If we put them at 20 times earnings, 20 times, you end up with $315 stock. That's 125% upside. Why is Oracle getting punished? Because the market does not like the money they are spending. When you look at free cash flow, look at all that money that they're spending. They're going to be blowing money for AI. I would put this in that neo cloud category of a business. But now, as soon as you look at operating cash flow, so this is the cash flow they're getting from their operations. This does not include the money that they are spending to grow the business. This is just accounting for the money that they have to spend to keep the business going as it is in the current state. Operating cash flow is going to grow 54% for 2028 and 13% the year after that. And they're trading at 12 times operating cash flow. This company has massive growth ahead. And then we look at the earnings. The earnings, 34% growth, 45% growth, massive growth. As this company matures and some time goes by and the market realizes that all this CapEx is paying off, then the stock will re-rate. Now let's look at some revenue for Oracle. And if you like this, make sure you get subscribed. Comment below some stocks you're looking at that are in the similar theme, similar situation as these. Look at this. $89 billion, 32% growth, $130 billion, 45% growth. So you're having growth accelerating for 2028 from all the CapEx that they're spending today. And then 40%, 39% in 2029. 2029, they're going to be doing $180 billion in revenue. In their statistics, they're $400 billion company. They're trading at a little more than 2 times revenue a couple years out from today. You're telling me this company is not going to be much higher than it is today? Easily, this company could trade at 4 times revenue, which if these numbers hit, would put this closer to an $800 billion, $750 billion market cap. Again, you're at that about 100% upside looking at it that way. You have to believe in AI. You have to experiment with AI yourself, and you will understand what is happening and why so much money is being spent by these businesses. Go build a website using just AI, and you'll understand why we are so early in the AI build out and the AI bull market. What's another name we can do for fun? And then we'll wrap this up. Okay, we have Nebius. I love that one. I love Palantir. Palantir is going to be massive. Oracle, Nvidia, Broadcom, Nvidia. These ones are massive. All these names the charts look all the same. The charts are insane double digit, some of them triple digit growth rates. And let's look at Marvell. Marvell is in the similar theme of I think it's CPO, co-packaged optics, and what's the other term that I've been hearing? But Marvell, another name that has massive growth. What am I predicting on here? Marvell, $237 stock, $9 earnings times 40 times sales gives you a $360 stock. It's 52% upside in just a couple years. Marvell. Boom, look at that. The stock was at $310 already, trading at 94 times earnings, and has re-rated down to 70 times earnings at $235. 40% growth this year. Then next year, we're looking at 52% growth, and then 47% growth. And this is 23 analysts that are giving you this number. Now let's look at the free cash flow, because remember, boom, here you go. Another company that already has positive free cash flow. If you want to stay away from the negative free cash flow companies, because those ones are going to have the hardest time to re-rate higher, then just stick with the ones that are already printing money and are going to continue printing even more massive amounts of money. And this is the company that Jensen Huang came out and said, they're going to be a $1 trillion business. Look at this, 91% growth, 65% growth, 50% growth in free cash flow. These names have so much growth in these next few years. Marvell, let's look at the statistics. You're a $200 billion company. So you're a 5x away from where Jensen Huang has said this company will be worth. Jensen Huang said this company is a $1 trillion company, and they're trading for $200 billion. And it's July. It's July in 2026, and you can pick up Marvell for $200 billion market cap with 40% growth, 44% growth, 38% growth. I've never seen so many businesses with such insane levels of growth ever. Literally ever. There's always been one or two names. There's been the Palantirs pre-AI with this crazy growth. But to have so many names with these insane revenue growth rates, these insane earnings growth rates, and right now the market is giving you a chance to get into these names at, I think, are reasonable prices, not financial advice. But again, they're going to be doing $23 billion in 2029 with $9 billion in operating income. So like 45% is going to operating income. Or sorry, yeah. You can look at any of these names and create a simple little sheet like I did here and figure out your own price targets. But this is where my mind is at. These are the names that I'm looking at currently. And some of these, my technical analysis, I'm looking at them and I'm saying right now these don't look super great as buying opportunities at these levels. But then I have names like Nvidia and Broadcom with a double B. Double B means buy. So we look at Nvidia. Whoops. All right, Nvidia. Look at this. Hit the support right here at the 193 and just absolutely ripped. We're back up to 210 now. This company is a buy. This company is going to rip. This company is worth double what it is in a couple years, in my opinion. Easily, Nvidia should be trading at a 30 times multiple with the growth and the importance that they have in the market. Easily, I could see Nvidia in a couple years being a $400 stock, which would put them at 10 trillion, I think, which we've made a video about. Nvidia 10 trillion, yeah. Double that, you're a $10 trillion company. Look at this, 80% growth for 2027. That's coming from 65% growth for 2026. So they're accelerating their growth rate. It's insane. Then 40% and then 20%, but these numbers are less accurate, obviously, because they're further out. Anyways, you get what I'm saying. These companies are cheap, and I think the TA is telling me Nvidia's a buy, Broadcom's a buy, the market's a buy. Boom. Very similar chart to Nvidia. This is Broadcom. Look at this. We tapped on that 359, that 360 level, caught the support right here, and we're back up here around the 400 level. Really, Broadcom has to break through this 400. But again, if you're looking at long-term compounders to put your capital to work in, I think Broadcom is a great name to carry your capital. Not financial advice. Look at this. Earnings growth for Broadcom, 65%, 34%. And we're trading at 39 times today's earnings. And we're growing earnings 70%, 65%. Your PEG ratio is less than 1. Your forward PEG is well under 1. Free cash flow, 87% growth next year. 32% growth. You're trading at 45 times free cash flow. In the long term, long term, 20 times free cash flow, 25 times free cash flow is where I would see a business trading at. But when a company is growing as fast as Broadcom, they're obviously going to trade at a higher multiple. Could I see them trading at 30 times in 2028? That would put them at $745. And they're trading at 400 today. What was my number over here? Broadcom, $644. I'm doing it off the earnings at 25 times earnings. But the point is the same, is that all these companies, I see massive growth ahead. I think all of these are good names for long-term investments. And that's the video I got for you. So hope you enjoy it. Make sure you make sure you get subscribed. And if you haven't already, check out feedmetrades.com. It's a website I built where you can track all your trades. You can track your calls, your puts. You can track your covered calls. You can track your debit spreads, your credit spreads, anything with options. You can track it on feedmetrades.com. It's a great way to separate your portfolio, because I know for myself, I have long-term positions in my portfolio, and I also have these option trades that I'm doing, and it's hard to tell how my portfolio is performing based on the long-term positions and different options that I have. So I've created feedmetrades.com as a website where you can track strictly just option trades. So stay healthy, stay wealthy, and stay tuned for the next one. Peace. And drop a like. Subscribe.